Hi, welcome to Binance Academy courses. In this Trading Basics course, we will learn the fundamental concepts of trading in 5 modules. By the end of this course, you should be able to tell the difference between trading and investing, understand technical and fundamental analysis, and grasp the concepts of financial markets and market cycles. In this first module, we will discuss what is trading and investing. So, what is trading? If you've been involved in financial markets, you've likely got an idea of what trading is. The term can bring to mind hectic stock trading like you might have seen in the movies, but what's the technical definition of trading? An essential part of economics, trading refers to the buying and selling of assets. Whether you're purchasing groceries, swapping euros for dollars, or buying Tesla stock, you're making a trade. Any activity where you give something to someone in return for something else is a trade. When it comes to financial markets, we typically talk about trading financial assets like stocks, bonds, forex pairs, options, and cryptocurrencies, among others. Each trader adopts a different strategy according to their risk profile and tolerance. For example, day trading is one of the most common strategies, in which a trader buys and sells financial assets within the same trading day. Another option is swing trading, in which trading positions are open for a few days or weeks. Then, what is investing? Trading and investing are commonly confused concepts, so what exactly is the difference between the two? The aim of both these activities is similar, but they're somewhat different in their methodologies. When you invest in something, you hope to get a return on that investment. This means you'll get back the money you put in, plus extra. You could invest in a small business, house, or financial asset with a plan to sell it later at a profit. If you invest well, you might even be able to double or triple your initial capital. While a trader also wants to make a return, they do this over a much shorter period. So while a trader might buy the same cryptocurrency as an investor, traders are looking to make gains from short or mid-term price changes. Traders frequently enter and exit positions to generate smaller returns over many trades. In contrast, investors play the long-term game. So, how do investors and traders decide what to buy and sell? Typically, investors and traders perform analysis before risking their money. The analysis frameworks they use can be broken down broadly into 2 categories: fundamental analysis and technical analysis. We will learn about these 2 analysis frameworks and how they work in the next module. Investors and traders perform analysis before risking their money. The analysis frameworks can be broken down broadly into 2 categories: fundamental analysis and technical analysis. Fundamental analysis tries to identify an asset's intrinsic value. This is achieved by looking at economic and financial factors in an attempt to find the fair value of an asset. You may look at macroeconomic factors like the global economy or an industry's state. Microeconomic factors can also be important if you're investing in a business or an asset related to a business. The end goal is to establish whether an investment is undervalued or overvalued by the market price. Let's look at an example. Imagine you purchase a hypothetical cryptocurrency called cryptocurrency A. You buy cryptocurrency A for $10, but your research into the project and founders suggests its real value should be $20. You may then decide to invest more in cryptocurrency A in anticipation of it realizing its fair value. When it comes to cryptocurrencies, there are specific fundamental analysis techniques you can implement. On-chain metrics look at raw data available on public blockchains. These figures include a token or coin's network hash rate, distribution, number of active wallet addresses, and other transaction metrics. With this combined information, fundamental analysis can create indicators to help inform investors' investment decisions. Fundamental analysis has been popularly used in stock markets, but applying these techniques is relatively new in the crypto world. There isn't a standardized, comprehensive framework established yet. The methods can vary greatly from one investor to another. You should also note that crypto markets are largely driven by market sentiment and narratives. Depending on the context, fundamental factors can have negligible effects on a cryptocurrency's price compared to fear or greed in the market. In other words, market sentiment may cause prices to change in unexpected ways that don't match the conclusions of fundamental analysis. Next, what is technical analysis? Technical analysis uses previous price and market data to try to identify price patterns and predict future price movements. Unlike fundamental analysis, technical analysis isn't concerned with an asset's underlying or intrinsic value. Instead, technical analysts study price changes, trading volume, chart patterns, technical indicators, and other charting tools to forecast future price moves and trade on these predictions. In short, we can say that technical analysis disregards news and other fundamental factors and is mainly focused on market charts. Technical analysis applies to any financial market and is very popular among cryptocurrency traders. But is it actually effective? To some specialists, technical analysis creates a self-fulfilling prophecy. Technical analysts make market predictions using the same techniques and indicators. If enough traders and analysts also believe the same predictions, this can change trading behavior and confirm the predictions. This potential effect means that technical analysis can be effective sometimes and unreliable in other situations. On the other hand, technical analysis supporters argue there's a large range of opinions and analysis methods. This means that the chances of a large group of traders making the same analysis and behaving similarly is very low. Another argument in favor of technical analysis in the crypto industry is its reliance on price data. Some argue that many crypto traders are not interested so much in the fundamentals of a project, but are mostly driven by price predictions. This makes technical analysis more suitable. Others have argued for crypto investors to focus more on the fundamentals. Of course, fundamental and technical analysis are useful in distinct ways. How should they be applied to crypto trading and investing? That's what we will explore in the next module. We have learned fundamental and technical analysis, and you might wonder which is the best to use for you. The answer is each methodology has a different approach that can be suitable at different times. For example, it makes sense to use fundamental analysis if you want to invest and forget over a long period, as technical analysis requires you to regularly check the markets and trade frequently. Fundamental analysis is especially useful with less volatile assets that derive their value mainly from a business or product. Stocks are a good example of this. It's simple to see that the performance of Apple stocks depends on the company's products and their success. You might want to use fundamental analysis to invest in stocks over a long period of time, which is a lower risk method of investing. However, if you're looking to make gains over the short term, technical analysis might be a more suitable analysis framework. Short-term price movements can be more effectively explained via technical analysis. This is because traders make a call on whether an asset's price will increase or decrease based on previous price action and technical indicators. Short-term trading relies mainly on trading charts and not on the asset's fundamental value. It's also important to understand that traders and investors don't just have to stick with one type of analysis. It's common for the two to be combined, especially among crypto traders and investors. Let's look at an example. Alice has conducted fundamental analysis on Ethereum and found that its planned future improvements are likely to significantly drive up demand for the network services over the next several years. It will likely lead to significant upside for Ether price. But due to market sentiment, Ether's price has been bearish and dropping consistently. Alice believes that Ether is oversold and buying Ether would prove to be profitable long term. However, her technical analysis suggests that Ether price is likely to continue to drop. Alice waits until Ether price drops to a level that her technical analysis points to as a bottom. Alice then purchases Ether and plans to hold until she can realize Ether's long-term price appreciation. As you can see from this example, Alice has a higher chance to maximize her returns by combining both fundamental and technical analysis. But you must remember that past price performance is no guarantee of future results, and fundamentals can't always explain price movements. This principle of combining multiple analysis methods is called confluence, allowing traders to create a single strategy with the benefits of them all. Trading opportunities presented by the combined strategies could prove more robust than ones from a single strategy. Your trading style will ultimately dictate the mix you use and will depend on your risk profile and trading time frame. It's also important to understand market trends and cycles when you invest and trade. We will learn how to read market trends and cycles in the next module. In order to be successful in trading and investing, you need to understand financial markets, market trends, and cycles. Let's dive into exactly what they are. A market is simply where buyers and sellers meet to trade. Going to the grocery store to buy apples is an example of a market. The price you pay for something in a market is dependent on the balance of supply from sellers and demand from buyers. If the grocery store is struggling to supply apples, but consumers want to purchase lots of them, the price will increase. If there is no demand for apples but a huge supply, the price will decrease. Anywhere supply meets demand, a market exists. Financial markets take the same concepts as our grocery store example, but instead they deal with financial assets. Supply and demand create the market and determine prices, but what exactly makes up the levels of demand and supply in a market? The amount of assets supplied for sale in a financial market has many reasons behind it. For example, the supply of gold can be affected by the amount mined, production costs, and import taxes and tariffs, among other things. The overall demand in a market like gold can be affected by the state of the global economy, returns on alternative investments, and other factors. Many see gold as a place to store money when there are economic problems or in an emergency. If financial markets are down and we are perhaps entering a recession, some people like to invest in gold as a safe haven, causing the demand to increase. Whether we are talking about apples in a grocery store, gold on financial markets, or cryptocurrencies, the principles of demand and supply are always the same. The only difference will be what affects supply and demand in each financial market. There are two main types of market trends: bullish trends and bearish trends. A bullish trend would be a noticeable increase over a period in the market price of an asset. A bearish trend is a noticeable decrease in an asset's price over a period. Market prices can also move sideways, otherwise known as consolidating. In this case, there's no clear directional trend. As these trends continue, we can describe a market as being bullish or bearish. If there has been a string of bullish trends in a row, we can probably say that we're in a bull market. The same goes for a period of continued bearish trends. In this case, we could assume that we're in a bear market. However, a bull market doesn't have to be one long, continuous, and constant rise in price. Sometimes a bull market will have some smaller bearish trends in it. The same goes for bear markets too, as they can also have some bullish trends in them. In fact, we only get the full picture much later, and we can only determine markets and trends with certainty and hindsight. Lastly, you may have heard that the market moves in cycles with repeating trends. Almost every asset will experience cycles between bullish and bearish markets. Long-term market cycles are more reliable than short-term market trends and can be easily seen on graphs with decades of data. If you take a look at the stock market's performance or crypto markets over the past few years, you'll easily be able to identify the market cycles. Shorter cycles will appear as you zoom in on shorter time periods. As with market trends, it's challenging to determine what stage of a cycle we're in and when a new one will begin. Understanding market trends and cycles is critical to be successful in trading and investing, but getting to know how market psychology impacts market trends is equally critical. We will learn what market psychology is in the next module. In this module, we will learn what is market psychology and how that affects market cycles. Market psychology is the idea that the movements of a market reflect, or are influenced by, the emotional state of its participants. It's one of the main topics of behavioral economics, an interdisciplinary field that studies the various factors that precede economic decisions. Many believe that emotions are the main driving force behind the shifts of financial markets, and that the overall fluctuating investor sentiment is what creates the so-called psychological market cycles. Market sentiment is the overall feeling that investors and traders have regarding the price action of an asset. The sentiment is made up of the individual views and feelings of all traders and investors within a financial market. You can also think of it as an average of the overall feeling of the market participants. But, just as with any group, no single opinion is completely dominant. Based on market psychology theories, an asset's price tends to change consistently in response to the overall market sentiment, which is also dynamic. How do emotions change during market cycles? All markets go through cycles of expansion and contraction. When a market is in an expansion phase, or a bull market, there is a climate of optimism, belief, and greed. Typically, these are the main emotions that lead to a strong buying activity. It's quite common to see a sort of cyclical or retroactive effect during market cycles. For example, the sentiment gets more positive as the prices go up, which then causes the sentiment to get even more positive, driving the market even higher. When the market starts to turn the other way, the euphoric mood can quickly turn into complacency, as many traders refuse to believe that the uptrend is over. As prices continue to decline, the market sentiment quickly moves to the negative side. It often includes feelings of anxiety, denial, and panic. How do traders and investors use market psychology? Assuming that the theory of market psychology is valid, understanding it may help a trader to enter and exit positions at more favorable times. The general attitude of the market is counterproductive. The moment of highest financial opportunity for a buyer usually comes when most people are hopeless and the market is very low. In contrast, the moment of highest financial risk often arises when the majority of the market participants are euphoric and overconfident. Thus, some traders and investors try to read the sentiment of a market to spot the different stages of its psychological cycles. Ideally, they would use this information to buy when there is panic and sell when there is greed. In practice, though, recognizing these optimal points is rarely an easy task. What might seem like the bottom may fail to hold, leading to even lower bottoms. Psychology has an impact on market prices and cycles, and the psychological market cycles are well known, but they're not always easy to read. From the Dutch tulip mania in the 1600s to the dot-com bubble in the 90s, even skilled traders have struggled to separate their own emotions from the overall market sentiment. Investors face the difficult task of understanding not only the market psychology, but also their own psychology and how that is affecting their decision-making process. Congratulations! You've completed Binance Academy's course on trading basics. Remember to check out Binance Academy's website and follow us on YouTube, Facebook, and Twitter to stay tuned for future courses. See you in Binance Academy's next course.